What'd you think of that list? I could have kept going, but we literally, for the first time ever, ran out of space on our giant graphics wall.
Well, first, Brian, great to be with you. It is a pretty wide list. And listen, these are things we're hearing anecdotally every day. I think we're all seeing it. Even me personally, you know, I called up yesterday to get a refrigerator. They said, hey, see you in September when you can expect that to be delivered. So we're seeing that it is a it's a short-term supply issue because of the shutdowns we saw during the COVID shutdown. I will say, you know, if you're looking at the more from a market perspective, we're still seeing the forward earning estimates move forward. So that's telling us that at this point, companies are able to pass through some of these costs. And if you're going to raise prices, probably no better time to do so when you have, you know, in excess of $2 trillion of savings and this, you know, $5 trillion of stimulus over the last year.
Yeah. Okay. So let's look at that. New cars, used cars, nickel, platinum, palladium, iron ore, copper, all the raw materials that go into things. We talk about, and by the way, our viewers are thinking, well, we don't care. We don't care about that stuff. Doesn't affect us. Yeah, it does, because companies, you don't think they're going to pass that along if they can. And that's key for stocks, is it not? Profit margins. And as long as they can, if their costs go up 10%, as long as they can pass on 10% or more to their customers or consumers, margins stay the same, markets are happy. Do the companies have the pricing power now, Keith, to do that, to keep margins and earnings stable?
Well, I think certainly this is going to be a mixed bag, but overall, I would say the answer is yes. And again, we can see that by not just what I think is, but what are the earning estimates and the industry analysts that look at these companies, you know, individually, and we're seeing those estimates move up. What's interesting this year, Brian, is, you know, the market's up about 11%. The forward earning estimates are up about 11% year to date as well. And we're continuing to see forward guidance move higher. But again, I think it's not going to be every sector. You're seeing places that, you know, you may benefit from this. Think about industrials, think about materials, think about if you start to see these wage pressures lead to higher rates, what does that mean from a sector position? It's a lot different than last year. And you want to kind of be, you know, in the same path of these trends. So that's why we like, as I mentioned, materials, even, you know, financials as well, and industrials that can help push through some of these prices and keep or maintain profitability. Yeah.
Let's talk about something else, Keith, and that is taxes. You and your team did some excellent work, put out a note talking about tax policy as it pertains to the markets. And I know a lot of our audience right now, they're CEOs, they're CFOs, they're business owners. They feel like maybe they're already doing their fair share. And people are worried that higher taxes may hurt stocks. The problem is you've proven not a lot of historical correlation between tax policy and the stock market. I know a lot of people aren't going to want to hear that, but history and the data says it's kind of true.
Yeah, and we're really fact-driven. And I will say, Brian, all the research we've done just shows a very tenuous relationship between tax policy and the market. That doesn't mean that taxes don't matter. They do, but so many other factors matter as well. And we went through the history of this, and it's just really a mixed relationship. Now, you can go by decade, and you can look at one of the highest tax decades of the last 70 years, which is the 50s. Great stock market performance, great economic growth despite high taxes. And then you move to the 2000s, where you had very low taxes, but you had very weak economy, and you had very weak stock market returns. And then even the last decade, Brian, remember 2013, we raised taxes, a lot of consternation then, but the market was up a lot. And then in 2018, we reduced taxes, and the market moved sideways. And again, I'm not saying, or we're not saying that taxes don't matter. It just means so many other factors matter. What are valuations? What is the Fed doing? What is the geopolitical climate? Where are we in the business cycle? And the business cycle tends to trump many of these other factors. And we're still relatively early in this business cycle in our view.
And you think, Keith, you got to go. You think stocks overall can move higher from here?
Yeah, but I definitely think it's going to be more of a 2 steps forward, 1 step back, and we are going to have some tensions between higher taxes, higher rates versus the better economy and earnings that we foresee.
Shepard Smith here. Thanks for watching CNBC on YouTube.